This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Brett Calhoun, Managing Director and Partner of Scale VC. Scale is an accelerator fund and venture studio investing monetary and social capital in early stage tech founders. Brett, thank you for joining us.
Thanks for having me, Hall. Look forward to diving in.
Great. And so where are you calling from today?
I'm in Columbia, Missouri.
Great. Well, let's start off with your background. What did you do before this?
Yep. So my career, I started out in accounting finance. I did the CPA route, never did public accounting. I did more evaluation work for sell-side M&A, litigations, or purchase price allocations or tax purposes. And then when I was in grad school getting my MBA at University of Missouri, had the opportunity to dip my toes into the venture world and worked with an accelerator fund here in Columbia. It's not around anymore. The fund's since been deployed, and fell in love with the opportunity to help other founders build companies and invest in them and help them get the resources, network effects, and knowledge that they need to get to the next level. From there, I had the opportunity to work with one of our portfolio companies as an early employee company called Patient Technologies, which they just raised about a $40 million round, and they're still based here in Columbia, Missouri. So I worked with operations and strategy there, worked on pricing, get to market, and some different product ideas that we were trying to roll out. And then I had the opportunity to work with the first venture capital fund focused on legal technology called the Legal Tech Fund. And we had done our first capital call when I was there. And then we actually incubated a company called Cap Gains, which is a fintech building software for complex tax incentives, starting with qualified small business stock, which everybody listening to this call is probably concerned with QSBS, because if you are a shareholder in a early stage tech startup, you probably have that, which when you exit that company in 5 years, you don't pay any taxes on those capital gains. And we're helping people realize that tax incentive. And then around the same time, I also co-founded a company called Charlie Mike, which is a lending startup for veterans. So we were really aligning the entire value chain, where we would bring in loan officers and help them close more loans by giving their borrowers more access to capital for the closing costs. So VA mortgages are 100% financed, but there still is a lot of expenses for the closing costs at the end. And so we could automate that with no underwriting. And we had quickly, within 12 months, scaled that to a little over 1 million in ARR. All this leading into what I do at Scale now, which is investing in really early stage companies and kind of also working on the front lines with them and helping them build in the trenches.
Well, that's great. Well, tell us more about starting a business with venture capital. How is this different from any other business?
Yeah, so most businesses or traditional companies you're starting, it's at the very beginning, you're really concerned about the cash flows and then taking those cash flows or capital and reinvesting it in the company. And you might have assets that you're financing, so you have the ability to get some lending or debt financing from a bank to collateralize those assets. But in venture, it's a much higher ceiling where you're looking to build a global company or a national company into a multi-billion-dollar business. And the capital that you're getting from the operations of the company reinvesting is just not enough to reach that scale and the amount of time that it would take. And so starting a company in venture, obviously, you still go back to the first principles of starting a company, which is completely focused on the customer and spending a lot of time in customer discovery and product discovery. But to take it to the next level and really scale that company once you hit product market fit is impossible to do without venture capital. And so in my opinion, venture capital is one of the greatest things for our economy today. And it's, I believe, 60% of the market share in public companies were backed by venture capital. And I think 40% of the economic output comes from venture capital backed companies. And so that's also said, I mean, that capital is being directed towards more than just, traditional local or regional businesses. It's international, national companies. So that would be the biggest difference in my opinion.
And what is the opportunity? How much is invested in venture capital, and what are the possibilities here?
Oh gosh, was it 200 billion, or I can't remember what it was. I'd have to pull my pitch book, stat book. I just saw this the other day. There's billions of dollars invested in venture, which is just a very small percentage of private equity in general. But that multi-billion dollars in venture results in trillion-dollar outcomes. And yeah, I would say some of the challenges with starting a business with venture capital funding is one, if you're a first-time founder, trying to navigate the venture network is really hard. So there's a few, especially coming from the Midwest, if you don't have the network effects starting out, it's very challenging, or the knowledge sharing. So if you look at the Midwest, historically, there's been massive capital constraints, and those capital constraints also result in people leaving. So you lose talent because there's a lack of capital here. Then you start losing network effects, and which are one of the most important things. Because you're losing the network effects, this wheel just keeps turning. So it's really important to get access to the right mentors and other founders who have built companies who can connect you to investors and share knowledge with how to pitch investors and articulate what you're doing and how that's different from articulating it to investors or future employees. There's other constraints as well. If you're an immigrant founder or, founder from an ecosystem that has never really been exposed to venture, the other challenges are pairing the need to raise capital with also the need to talk to customers and sell your product and get out there and build it. And a lot of companies get into this chicken and egg problem where, depending on the industry of product you're building, you get into a position where it's, what you need to build, but you can't build it without the capital, but the investors won't give you capital until you've built the product and shown traction. So that is one of the biggest challenges in venture. And then a lot of founders I see will try to build companies or raise capital based upon an idea. And maybe they have done a lot of customer discovery, but they don't have any technical founders on the team. And so they're raising capital to hire an outsourced dev shop, which turns into massive problems in the long term with tech debt, because you're then raising capital to go hire a dev shop that at the end you might run out of capital and end up with a half-done product, or you end up with a product that is really hard to change and you don't know the ins and outs of it because you weren't the product manager as the founder, which every company that's being built should be built. The founder should be the product manager of that company. So you have to have somebody technical on the team. Other problems I see are the fact that a lot of people, when starting their company, envision that you immediately have to raise capital, or one of the biggest wins to check off on your book is that you're raising capital and there's this high profile and you have to get PR and all this stuff. But what that clouds is that you have to go back to first principles and focus on talking to customers, and then taking what you're listening to from customers into a product and building a solution, and being really scrappy in the early days. You might even not have to raise capital. You might tell yourself you think you have to raise capital because that's what everybody else does. But a lot of times you don't even need to raise capital yet. So a lot of times I'm talking to founders, let's build out a cash flow model. Let's understand what you need capital for, and do you actually need it or do you want it? Because what is important now is building the right product and getting traction and being able to iterate on what the minimum viable product is. Now, it doesn't mean building a perfect product. It's building something that you can learn from and distribute. Because a lot of times it's the person that's always the innovator and trying to build the perfect thing often loses to the person that builds a minimum product that learns how to distribute that to their community of customers. And a symptom of building a really good product and distributing it is the opportunity to raise capital and funding from investors.
That's great. So how much are companies selling for here? What's the potential reward?
How much are companies selling for in venture capital? Well, after 2022, I think that was our biggest downturn in M&A in history. So I don't know if companies are selling at all in general, but in terms of scale, our companies that we've invested in, we have not had any exits yet. We made our first investment September 2021. So our 2021 vintage is not quite seasoned to the point where there's any exits yet. If there was, that would be insane for our LPs. So I can't necessarily say we're generalists and we're operating in industries, many different industries, which, if you look at hard tech as opposed to software, or the location, the valuations that companies are raising at are going to be fluctuating based on those data points. So I don't have a lot of good data right now on what companies are selling for. It also depends too, like if your acquirer is a strategic acquirer or if it's somebody who's trying to shut your company down. I mean, it really just depends.
Right. So there are many venture studios out there. What helps you stand apart from the others?
Yeah. So the studio model has been around for a little while. It's starting to become a little bit of a trend. And historically, the studio model has been, you have an entire army of engineers, branding, marketing, salespeople, and you position them on an idea that you do some research on. You build the first product and you start testing in the market. And then you say, hey, let's go out and find an operator, run this company and take it to the next level. That's great. The downside of doing that is that the person that you bring in to be the CEO, founder, operator comes in when the company's already partially built, and it's hard for them to have a personal connection with that company, similar to somebody who starts a company from ground zero. So how we've tried to think about this model is, sure, we have internal ideas as a team of builders, and we'll go do some research on our hypothesis for that particular problem. And then we go source founders who are operators and technical people to come in and build that company, be the founder of it, and give them the bulk of the equity in that company so they feel like it's theirs. And they're incentivized to go through the constraints, the rough nights, the downturns with that company. And we don't surround them with a team. We say, you're going to get the same investment as our accelerator companies. We want you to feel the same capital and resource constraints as a typical founder, because those constraints unlock creativity, and the founders that normalize those constraints use those constraints as a power to build their company and produce outsized alpha. And so we don't necessarily like to arm people with an entire team and have all the resources in the world to start out of a company, because it's, in my opinion, it's setting people up for failure in the long haul. So how we've done it too is, we do surround those founders that we bring in with really strong mentors. So my partners at scale have built a company called Equipment Share, which they started in 2015, then went through YC, and it's now a multi-billion-dollar company, and they've got, 4,000 or 5,000 employees. And so a lot of their learnings are regurgitated back into the founders that we're bringing in through scale. We're not trying to remove the constraints, but remove some of the unnecessary barriers that you will face down the road with your company and the insights that you might not gain until you're 3 or 4 years into building.
And so what advice would you give to someone entering the VC startup space?
The advice I would give is, when you first enter the VC space, you see all these companies and everything is somewhat new. There's all these technologies that seems very cool. You just kind of want to invest in everything. And what I would say is to try to take a step back, and this might be a bad word, but take a more cynical approach and not be a champion right away with every company, and to really dig in and understand why that company is a good investment. I would also say a big thing that's helped me is continuously reading and consuming content. To be honest, like, venture capital is a lifestyle. And so it's always reading books, reading articles, listening to podcasts, networking with people, and trying to understand how other people are thinking and how they're approaching venture capital, and to keep an open mind about it. So you have your own personal opinion, and you want to stay true to that opinion, but have the opportunity to mold it based upon some of the new things that you're learning in the ecosystem that's ever changing. I mean, venture today is completely different than it was 10 years ago. And I've seen so many investors who like to stick with what was happening 10, 20 years ago, and just, they are very hesitant to change with the market. And another thing I would do is constantly be talking to, depending on what industry you're investing in. For us, we're agnostic, so it is somewhat hard. But if you have a focus or a thematic fund, it's always talking and doing your own customer discovery as if you're a founder, so that you understand the intricacies of that particular market, and you're talking to people who have boots on the ground and listening to those customers. Because in order to really make sound investments, you have to understand the products that are being sold to the end customer of those companies, or you're just flying blind, in my opinion.
Great. Well, what online information source do you find most helpful in your work?
There's a lot. I'm always on, I probably read, I don't know, a dozen or two Medium articles a week. There's a lot of good authors on there. I've got quite a few newsletters that come through. And one way that I dig into this content is I do a newsletter every month where we take in probably, I don't know, 100, 200 articles and different podcasts and different news sources, data points, and filter through those every single month. And so the newsletter obviously is to get Scale's name out there and, provide value to our readers, but it's also a source that forces me to keep constant on what's happening in the market and continue my learning. I would say some pretty good podcasts just throw out there. Obviously, Investor Connect. The Full Ratchet is a good one. I listen to 20 VC. Obviously, you have to, everything you're bringing in, you do have to keep with a grain of salt, though. For particular markets, I would say content that I'm consuming is I still take some continuing education classes on various things, whether it's on AI or financial modeling or whatever it is. So it's a constant. If you're going to exceed in this industry, you can never stop learning. I mean, that's said for any industry, but particularly in venture capital, when things are changing like within seconds, it feels like the continuous learning is even more crucial.
Well, you see a lot of new business models and new technologies out there. If you could start a business tomorrow, what would that business be?
If I could start a business tomorrow, this is a tough one. I would say if I could start a business tomorrow, it would be something within physical infrastructure. And that said, because I think we're probably 100 years behind in physical infrastructure as we are with software. I mean, there's still so much opportunity for advancements in software, but with infrastructure or software for infrastructure, that has to do with construction and property technology is so far behind. And that's, the largest industry in the world. It's a $14 trillion industry. So at least construction is. And I think with the new improvements with going towards clean energy in existing buildings, like there is so much opportunity there. And then if you just look at particular niches, for example, buying and selling a home, it is still napkin paper like operations. And whether real estate agents will be replaced in the future, I don't know. What I do know is that a lot of their work is very monotonous and has had little innovation. I'd say like the greatest innovation in that space has probably been just having a Google spreadsheet where you can put your borrowers that you're talking to. And so it would probably be something operating within tools to enhance real estate agents and the buying and selling home process.
Well, great. Well, last question is, in the last minutes that we have, what else should we cover that we haven't?
Yeah, I mean, I can talk a little bit about some of the initiatives that we're doing at Scale right now. And the first one is we're putting on Missouri Startup Weekend on March 10th. And historically, originally was called Columbia Startup Weekend. We've now rebranded it to Missouri Startup Weekend. And historically, it's been a very successful event where people come in and pitch ideas, and then you form teams and work on those over the weekend and pitch it to judges. And then there's a winner at the end. The winner goes through our next cohort. But anyways, there's some very high profile winners previously at Columbia Startup Weekend, one being Zapier, which started in Columbia, Missouri. It's now a top 25 YC company, multi-billion-dollar company. The second is Equipment Share. It's a top 25 YC company as well, multi-billion-dollar company. And last year, our winner pitched our idea, went through Scale, and within 8 months got to double-digit MRR and also had term sheets from multiple VC funds. So we're putting that on March 10th and trying to bring together a community of builders from across Missouri and beyond. Another thing is we started a community called Flyover Tech. And if you think about all of the undercapitalized or flyover markets across the US, they're very fragmented. And so you think it's Silicon Valley, what makes it so great is that there's a constant feedback loop with investors, founders, customers, and there's always growing network effects, growing knowledge sharing. Now, if you look at flyover states, it's like you take Silicon Valley and just stretch it out, okay? And once you stretch this out, you start losing this feedback loop. You start losing the quick access to knowledge sharing. And so you have all these nodes across flyover states that are disconnected. And so we started Flyover Tech to try to connect people in Columbia, Missouri, to Columbus, Ohio, to Chicago, to Wisconsin, and create a better feedback loop, a better ecosystem where people are collaborating together. Because there's a lot of great ecosystems within these flyover territories, but alone, they're not great. They're just good. To get to the point where you're like a Silicon Valley or New York, you have to work together. So we started that, and then we've also got a talent network with a couple hundred people in it for our companies. So we source talent from across the US for our companies and scale because we're investing, pre-product, pre-revenue in most cases. And these companies are really early trying to look for their first engineering hires. And so we've done that as well, built that up. That's about it.
Well, great. So how best for listeners to get back in touch with you?
Yep. Best way to get in touch with me is through my email, which is brett@scale-vc.com.
Great. We'll include that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Awesome. Thank you all.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.